Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca. We have a good deal of volatility today as a result of the Fed's rhetoric, I would say, or talk about tapering interest rates. Since June of last year, we've been dealing with the monetary policies that the Fed basically is looking to implement. They have decided to taper about $30 billion a month. And so sometime in March, it looks like we're going to be finishing this tapering. Now, the argument is interest rates. And we have seen a bit of a spike on the 10-year note in the last week or so from basically the 130 area to about 173, which is what it's trading right now, 173.20. And we have seen a bit of a spike. As you can see, if we take a look at the weekly chart here for a minute, we're looking at the previous peak of 170, 172, 173. This was made earlier this year, in 2021. So it looks like interest rates are showing a major head and shoulder bottom on the 10-year note. And if we break out of this neck, basically, we're looking at testing the $2 to potentially the 250 level on the 10-year note. So if interest rates do continue to rally from here, it's going to put a lot of pressure basically on the Feds, because what interest rates are saying is essentially that it's beginning to factor in the potential inflationary pressures that we're dealing in the economy. I would say to you, after being around for a little while here, that this set of fundamentals here that we're dealing with right now are completely inverted to what the market really should be doing. When you really think about what's been going on with regards to tapering or interest rates, it's all been done on the minutes of the Feds, the talk, the rhetoric. And they always leave room open for them to change their mind if the economy dictates it. As they were saying before, inflation got up to 2%. They were looking at a target of 2% before they start thinking about tapering or interest rates. And now their argument is with regards to when to raise interest rates is when the unemployment normalizes. And if you take a look at the unemployment numbers and the Omicron wildfire that is spreading across the country could potentially bring in some type of economic slowdown. They're shutting down sports events, shutting down schools, are being affected, self-discipline or self-controlling parents basically are not sending their kids to school because there seems to be a wave of parents that even though their kids are sick, not only they're not being vaccinated, but they're sending the kids to school. So there is a lot of chaos, I would say, in terms of this pandemic, the effect of Omicron, and the chaos of the health system that essentially has lost control. So what does that mean to us, to the market here? Well, initially, obviously, the impact that we're having here in metals is very bearish. We're looking at gold down $36, and we're looking at silver down about $1.08. It is a highly volatile environment because of the fundamental rhetoric that's going on with regards to interest rates, with regards to tapering, with regards to the economy. Now, the markets, if we go back and we take a look at gold in particular, it's factoring in all of this talk, this fundamental talk. And if I may get into the artificial intelligence of the algorithm, it is showing basically that gold has come down into the blue zone. In fact, on a daily basis, it is extremely oversold. On the weekly basis, by trading below 1803, we're in a range of major support between 1803 and 1775. Trading below the average of 1817 gave us a bearish price momentum at 11:30 a.m. After the market came down from the sell 1 level of 1825. So when it came down below the average price on the weekly, it activated the extreme level below the mean. What you see here is that today the weekly average is 1817, which matches the daily average of 1817. This is what it's called harmonic alignment. And the targets below the extreme are completely activated. In this case, 1802 to 1794. As you can see, were completed. And upon completion, we saw a rally from 1794 at 2:15 a.m. And it rallied to complete the target of 1802 by 2:30 a.m. So a lot of action takes place on the Globex, and you can trade this indicator pretty much around the clock between New York, Hong Kong, and London. Coming back to the algorithm here, the market went into a bearish pattern by closing below 1802. Now, this is the trick, you might say, or the artificial intelligence that connects the daily to the weekly algorithm. And in this case, the weekly range is between 1803 and 1775. And the AI basically tells you that even though the price can't come down, as you see here, you want to look at these levels for the sign that we are beginning to revert, meaning that we have found buyers a lot sooner than indicated. In this case, the buy 2 weekly level. So I'm comfortable because the price has come down to a high probability level where it is recommending to accumulate supply here. This is a high probability area to accumulate supply. And so that depends upon you as a trader in terms of what instruments, how you build a position, how do you accumulate supply? How do you accumulate your inventory? And you have stocks, you have futures, you have options, you have a combination, ETFs, single, double, triple X ETFs. And that depends upon your profile. But coming back to the algorithm, the variable changing price momentum indicator is telling us that the market is in the highest probability area in these pivot points to accumulate at these levels. And we also see the cyclical patterns pretty much also confirming in a couple of hours, potentially the bottom is going to be made into this level. So what we want to see is actually the market confirming that. And the confirmation would be a close above 1794 for the gold market. Second alternative would be activating the buy 2 level of 1775. So for the time being, if you are an aggressive trader, you can start to accumulate into this area, and you can put your stop on a close below 1775 and see what the market does if you are willing to carry that much risk. So let the market trade here and see what it does, and we'll continue to update and watch this throughout the day. We have a lot of volatility in silver, basically making a low of 22. It seems to be coming down and testing this low here once again. It is extremely below the weekly and daily mean, so the market is extremely oversold, daily and weekly. Let's watch the market here for a little bit on silver as well. And if you're an aggressive trader, this area is a high probability of a reversion to unfold from here. 2277 close above is confirmation on the weekly. The monthly, if we take a look at the monthly, 2201 is the monthly buy one level, and we are right at that level. 2202. So we're pretty much activating a monthly signal here, alerting. This is an alert that if we close above this bar, this pivot point 2202, a monthly trigger point will be activated. So it looks like the fundamental news that are coming out with regards to tapering interest rates, Omicron, is making a bottom, potentially a bottom in the gold and silver market. And we're looking to capture this bottom here, separating ourselves away from the fundamentals, which I believe have been pretty much discounted in the market. When you take a look at this correction here, from the monthly average of 2275 by coming down below, it activated this price momentum, bearish price momentum that met the target here. Now, this may be a really good time here to talk about the difference between the price momentum and the trend momentum. And I had a question by one of my readers here regarding that, so I think this is a really great time to talk about mean reversion trading. He asks basically, then what do you mean by mean reversion as it applies to real trading? How does it apply in this particular case to gold? Is there some mean price of gold? If so, what? Question mark. If the price is not at that mean price, when will it revert? Okay. The first clarification is that the last price is not the mean price. The mean price is the average price. And the price, basically, when we talk about the difference between price momentum and trend momentum, the price momentum is the velocity of the price within the pattern, within this pattern that we're looking at. The price momentum is the momentum, the velocity within this bearish trend. If we take a look at the major trend. And in this case, we're looking at the monthly signals. And obviously, if you take a look at silver on the bigger picture, the big trend, you're looking at a bearish pattern that we've been in since 2542. This is the bigger trend. This is the bigger trend. This is the trend momentum. What we look at is at the price momentum using the 15-minute bar to activate live signals that are triggered using the artificial intelligence provided by the VCPMI. So you want to understand when we talk about the price momentum, which is the average variable changing price momentum, is really the velocity of price within that trend, within the bigger trend. In this case, the bigger trend is bearish and the price momentum is also bearish. When it trades below the average. When it trades above the average, it's bullish, as you can see here, within a bigger bearish trend. The thing that it identifies is the momentum, the price momentum aligning itself either against the big trend or going with the trend. And in this case, obviously coming down below the average monthly was going with the trend. And bottoms are made on a counter trend basis because they usually turn the market within the big trend, but on a smaller scale, basically using shorter time frames, shorter cycles, starting from a minute to 5 minutes to 10 minutes to 15, 20, and so on, daily, weekly, monthly, and then you go into the annual patterns. If you look at the market from a technical point of view, this is how you dissect the relationship of price, short-term and long-term, by identifying the bigger trend and using the shorter data basically to identify the price momentum within that big trend. And that is the big difference between price momentum and trend momentum. In terms of Bitcoin, we are in the area of accumulation of supply that essentially is weekly and daily. The daily buy trigger is at 42,170. The low is 42,375. So we are approaching what could be a major buying opportunity long-term for Bitcoin. So the market is either going to come down and activate this level or move up, and closing above 43,883 will activate the weekly signals for the rest of the week. One of the things that I want to point out is the energy markets. We have crude oil pretty much trading at 79, 80 dollars a barrel with a high of 80.24 again, and I haven't heard too many news about the energy markets, and this is not obviously positive for the economy. This is a sort of tax on top of everything else that's going on, fundamentally. So I think what our leaders, in terms of the Feds in particular, which are obviously dictating monetary policy, I believe are in a pretty difficult place in terms of what to do. Because The danger is, once again, that as we begin to move in the first quarter of this year, this potential economic impact regarding the Omicron could slow down the economy, and it could put a cap, so to speak, on any policy moving forward with regards to tapering, or raising interest rates. I think as the economy unfolds, the real data unfolds, we're going to find that the markets have overreacted to this interest rate rhetoric that's been going on, because nothing's been done except for the tapering. And as usually when the markets react to an extreme level based on its fundamentals, a reversion to the mean will unfold, and depending upon how much pressure they have gone to at the extreme below the mean, the reversion to the mean stands to be pretty robust, pretty aggressive, pretty violent in reverting to the mean. Once all this capitulation takes place, all this liquidation of margin calls and stops are completed, the real buyers, the real market, will enter into the bigger trend. And the bigger trend basically for Bitcoin, for gold and silver, are much, much higher prices, as the policies of stimulus continue to be pretty alive. And if, in fact, the Feds have to do a turnaround with regards to interest rates, I think the markets are going to react violently to the upside, as it will clearly see that what is needed basically is interest rates to go deeper into negative territory. Be patient, my friends. I think we're coming to an incredible opportunity on the long side of the markets. Have a great trading day. Be safe. Wear a mask. I'll talk to you soon.